Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Today, we're diving into a company that, well, it really forces us to ask, how does an investor navigate a valuation that seems completely untethered from any verifiable financial results?
Yeah, it's a fascinating one.
We're dissecting MicroAlgo Inc., trading on the NASDAQ under the ticker MLGO. It's a company whose stock price tells a story of, frankly, extreme volatility and some pretty serious risks. It often seems driven more by promises about the future than, present-day reality.
Indeed. And our mission today is to unpack that dichotomy. We'll be pulling insights from a comprehensive AI-generated analysis report from Stock Analytics AI, dated July 15th, 2025.
Okay.
We want to understand the true quality of MicroAlgo's business, its management, and maybe what its intrinsic value might really be, all while acknowledging these, well, wild market dynamics that currently define it.
Okay, let's unpack this then. To navigate this complex material, we've structured our deep dive into two main parts. In part one, we'll lay the groundwork, explore the business itself, its management, financials.
Right, the fundamentals.
Exactly. Then, in part two, we'll shift focus to market sentiment, ownership structures, and a comprehensive risk assessment before wrapping up with our final conclusions.
Sounds like a plan.
So let's jump straight into part one, the core business and financials, starting with chapter one, business analysis. When we talk about MicroAlgo, what exactly is their core business? And, how has it evolved? Because it seems like it's changed quite a bit.
Oh, absolutely. What's truly striking about MicroAlgo Inc. is its rapid, almost total transformation. It operates as a holding company, mostly through subsidiaries in China. Officially, it has two segments: central processing algorithm services and intelligent chips and services.
Okay.
But here's the kicker. There's been this dramatic strategic pivot. In 2021, algorithm services was about, say, 51% of their revenue. By 2023, it soared to 98%.
98%, wow.
Yeah, and their unaudited 2024 press release even claimed 100%. This shift was largely driven by them selling off Fed Electronics, which essentially dismantled much of their intelligent chips business.
So they've gone from something tangible, like chip resale, to this incredibly abstract algorithm services. That near-complete pivot, almost overnight, it flags a major concern about transparency, doesn't it? How do you even verify that kind of revenue?
Exactly. It's like building a house entirely on fog, as you said.
Yeah.
Their core offering now is these bespoke central processing algorithms. They say they're for internet advertising, online gaming, intelligent chip industries.
It was the pitch.
Their stated value proposition is enhancing computational efficiency. Things like algorithm optimization, accelerated computing power, data intelligence services. Chip resale, like we said, is basically negligible now.
Now, market position and scale, we're talking microcap here, right? What does that really mean for someone looking at this stock?
Absolutely, it's a microcap. As of mid-July 2025, its market cap is only about $51 million. But, and this is crucial, you see extreme volatility.
How vol?
I mean, the market cap has swung wildly from under $18 million to over $225 million in a pretty short time frame, too. They're based in Shenzhen, China, and they're a subsidiary of WeMe Hologram Cloud Inc., which holds a controlling stake.
WeMe Hologram.
Oh, okay. And with just 87 employees, they are truly a minnow compared to industry giants. So for you as an investor, that means inherent higher risk, dramatic price swings. It's not for the faint of heart.
And their primary value proposition sounds impressive on paper, right? Delivering comprehensive solutions, promising more customers, better satisfaction, cost savings.
Yeah.
Especially enhancing computation without costly hardware upgrades. Sounds great.
It does sound good.
But where the rubber meets the road is often in the competitive arena. How does that value proposition hold up when we move into, let's call it Chapter 1 continued, industry analysis? What industry are they actually playing in?
Well, they're certainly positioned in high-growth Chinese industries, data center processors, AI. The China data center processor market alone is huge. We're talking over $2.5 billion USD in 2025, projected to grow at like over 21% annually to nearly $6.7 billion by 2030.
Okay, that's significant growth.
Massive. It's fueled by Beijing's East Data West Compute program, national self-sufficiency pushes the AI explosion. So for any legitimate company in this space, the market opportunity is substantial.
A massive addressable market then. But who are they actually competing against? I imagine it's not exactly a small pond.
Far from it. The competitive landscape is formidable, dominated by global titans like Intel, NVIDIA, AMD, plus Chinese tech giants, Baidu, Alibaba, Tencent.
The big guys.
Exactly. MicroAlgo, with its 87 employees, is effectively a minnow in an ocean of sharks. It just doesn't show up in credible industry reports, which kind of suggests its survival might hinge more on these unverified claims about bespoke algorithms than any real market presence.
And what about the regulatory side?
Yeah.
China's tech regulations can be complex, right?
Mm-hmm.
Plus barriers to entry.
Oh, yeah. Incredibly stringent and constantly evolving regulations in China. Domestic content mandates, strict data security. For generative AI, there are even rules about socialist core values, content moderation. For a company like MicroAlgo, listed in the US, this creates a complex dual compliance burden, significant regulatory risk from both sides, China and the US, and the barriers to entry. Exceptionally high. Massive capital for R&D, infrastructure, talent, immense technical expertise needed AI, machine learning, semiconductor design, plus scale and brand trust, which the big players have built over years.
So if that's the landscape, where does MicroAlgo find its competitive edge? This leads us to Chapter 1 continued. Competitive advantage. Do they actually have a durable moat? Anything sustainable?
This is really a critical point. Our analysis suggests MicroAlgo possesses no discernible durable competitive advantage, no real moat.
Really? None.
Pretty much. They have virtually no brand recognition among enterprise customers. Their brand, if you can call it that, is known primarily in speculative trading circles, built on aggressive press releases, not, proven products.
Right.
As a microcap firm with so few employees, they inherently lack economies of scale, purchasing power. Their business model doesn't really create network effects, and there's just no evidence of a large, locked-in customer base.
But they've made a lot of noise about quantum computing algorithms, haven't they? Isn't that their unique asset?
Ah, yes, the quantum computing angle. MicroAlgo's primary claim to uniqueness is indeed this widely publicized research into quantum algorithms, Grover-based stuff, error correction.
So is it real?
Well, these announcements function far more as narrative assets. They are consistently theoretical, lacking any quantitative benchmarks or realistic commercialization timelines. What's truly telling, though, is that these announcements do correlate with sharp stock price spikes.
Yeah.
It really suggests their most effective unique capability is actually generating speculative interest through PR, which, let's be clear, is not a sustainable business model.
That's a crucial distinction. The gap between story and reality. Let's move on then to Chapter 2, management evaluation. The people running the show. What's their track record like, especially given these struggles and the big business model shift?
Well, the senior leadership, Chairman Ji Zhao, CEO Min Shu, they're relatively new, took over in December 2022. The average board tenure is just 2.6 years.
So not much history there.
Not much established history, and their track record isn't really defined by growth, but more by actions characteristic of, well, financial distress. We've seen multiple reverse stock splits, a 20-for-1 in late 2024, another 30-for-1 just now in July 2025.
It's to stay listed.
Primarily to regain NASDAQ compliance. Yeah, these are cosmetic fixes, not solutions, and they're inherently value destructive for shareholders. They've also engaged in aggressive, dilutive financing, and of course oversaw that pivot to the opaque algorithm services. Their response to delisting threats seems to be financial engineering, not building a sound business.
Okay, and what about communication, transparency, ethical reputation,
Right.
especially that point about what they say versus what they file?
Transparency here is a profound concern. I'd almost call it a chasm. The company's communication is just dominated by these promotional press releases about breakthroughs, which starkly contradict its filed financial statements.
That sounds like a huge red flag.
It's a major red flag. For instance, an April 2025 press release claimed RMB 53.4 million in net income for FY 2024, unaudited, of course.
Okay, claimed income.
But then you look at the audited Form 20F for FY 2023, their official filing with regulators. It reported a staggering net loss of RMB 266.2 million. That's over $37 million USD.
Wow. Loss versus claimed profit. How do they explain that?
They don't, really. This profound, unexplained swing makes their profitability claims completely unreliable, and then the ethical reputation is questioned by the structure of financing deals, like that $35 million convertible note issued to their parent WeMe Hologram Cloud.
The parent company again.
Yes. That note had extraordinarily favorable terms for the parent, like a 60% conversion discount.
Hold on. A 60% conversion discount. That sounds bad, but break that down. What does that really mean for you, a public shareholder?
It's profoundly detrimental. It basically means the parent company, WeMe, gets to convert their debt into MicroAlgo shares at a massive discount, often way below the market price when they convert.
So they get cheap shares.
Extremely cheap shares.
Yeah.
And this directly dilutes the value of every single existing public share you hold. Think of it as a significant value transfer straight from public shareholders' pockets into the parent companies. These related party transactions raise serious corporate governance concerns. It strongly suggests minority shareholder interests are just not a priority.
That is a huge concern. Okay, let's shift to Chapter 2 continued. Capital allocation. How are they actually investing their money? Or maybe, how are they not investing it?
Management says they're making significant R&D investments, claimed RMB 161 million in 2023. However, remember, cash flow from operations turned sharply negative in 2023.
Right, they're burning cash.
Exactly, which indicates the core business is actively burning cash. So any capital raised is likely essential just for covering operational shortfalls and servicing debt, not necessarily for, productive R&D that actually moves the needle. Their M&A strategy has actually been divestment, selling off Feta Electronics, which even led to goodwill impairment charges.
And are they doing anything for shareholders?
Yeah.
Buybacks? Dividends?
Absolutely not. MicroAlgo does not pay a dividend, no history of it, and given its unprofitability, it's in no position to. No evidence of share buybacks either. Instead, management aggressively issues new shares and these convertible instruments. Continuous severe dilution.
Like that note to WeMe.
Precisely. That June 2025 convertible note to WeMe is a prime example. 0% coupon, 360-day term, and that deeply problematic 60% conversion discount to the lowest closing price in the prior 60 days. It just reinforces this pattern. Aggressive, dilutive financing that preferentially benefits the parent company.
Okay. And what about their return on invested capital? Morningstar reported 8.32%. That seems incredibly high, given everything else.
You're absolutely right to be skeptical. That 8.32 per 2 ROIC figure needs to be viewed with extreme caution, maybe even disbelief. It's almost certainly based on those unaudited, profitable numbers from press releases.
Ignoring the actual losses.
Exactly. It fails to capture the massive audited losses and the consistently negative operating cash flow. A business that is fundamentally unprofitable cannot genuinely be generating a healthy return on invested capital. It just doesn't add up with their audited financials.
Right, it just doesn't align. Okay, let's dive into the actual numbers themselves with Chapter 3, financial analysis. What are the key metrics telling us about MicroAlgo's financial health, or lack thereof?
Well, as we mentioned, it's a microcap stock, market cap around $51 million. Inherently higher risk, volatility. We've seen those dramatic swings, over $225 million down to below $13 million.
Okay. What about revenue growth trends over the last, say, 5 years? Are they showing that top-line growth you'd expect from a supposed cutting-edge innovator?
Despite the whole innovation narrative, their audited revenue figures paint a picture of stagnation, even decline. It was RMB 529 million in 2021, up slightly to 586 million in 2022, but then down to 580 million in 2023.
So basically flat to down.
Pretty much. Even their unaudited 2024 claim of RMB 541 million continues this trend. This flatlining revenue directly contradicts any story of dynamic growth or expansion.
And profit margins. You already highlighted that huge credibility gap. What do the numbers explicitly show? This seems critical.
This is really where the story just completely unravels. The unaudited 2024 press release reported seemingly impressive margins. 28.4% gross, 3.7% operating, 7.1% net profit made them look profitable.
Okay, seemingly profitable.
Exactly. However, contrast that with their audited 2023 Form 20F. It showed that massive net loss of RMB 266.2 million. This vast, unexplained swing from a huge loss to a claimed profit is the single largest red flag. It renders any profitability claims from unaudited sources utterly unreliable. It's not a gap, it's a chasm.
So if they're reporting such massive audited losses, where does that leave their free cash flow generation? Are they creating cash or just burning through it?
They are absolutely burning cash. The cash flow from operations has deteriorated alarmingly. It was positive, RMB 98.5 million back in 2021, dipped to 13.2 million in 2022, and then plunged to a sharply negative RMB 45.4 million in 2023.
Negative 45 million.
Yes. This negative operating cash flow clearly shows the business is unsustainable on its own. It explains the relentless need for dilutive external financing just to keep the lights on.
This all paints a pretty grim picture for financial stability. What about earnings consistency and debt levels?
Their bottom line is incredibly volatile, swinging from, modest profit one year to massive losses the next. And that claimed 2024 profit still lacks audit verification. Now, the reported debt-to-equity ratio, around 15.6%, might look low superficially.
Yeah, 15% isn't usually alarming.
Right, but it's deeply misleading here. It completely fails to capture the immense off-balance sheet risk from those convertible note obligations, which, as we discussed, are a ticking time bomb of future equity dilution that isn't reflected in that simple DE ratio.
They also reportedly have a healthy-looking current ratio, 6.11. Is that maybe a glimmer of hope? A sign of liquidity?
Not really, no. While 6.11 looks strong on paper, it's not a sign of fundamental business health. It's almost certainly a temporary condition funded by those recent dilutive capital raises.
So borrowed cash makes the ratio look good for a moment.
Exactly, but with negative operating cash flow, that cash cushion will inevitably erode, which forces them to raise even more dilutive capital down the line. And, as we've noted, no dividend, no position to pay one.
Okay, let's try to make sense of the valuation then. Chapter 3 continued. Valuation analysis. When we look at standard metrics like the price-to-earnings ratio, PE, what does it tell us about MicroAlgo? Or does it tell us anything?
Honestly, any cited PE ratios, you might see figures as low as 1.34 or 0.43, but they are essentially meaningless and highly misleading. They rely entirely on those questionable, unaudited 2024 earnings.
Right, the ones that contradict the audited losses.
Precisely. If you base the PE on their audited 2023 losses, it would obviously be negative. And actually, most of their peers in this speculative microcap IT services space also have negative PE ratios, indicating widespread unprofitability. The price-to-sales ratio, around 0.2x, is maybe slightly more stable, but still pretty flawed when the underlying business is bleeding cash.
Okay, so relative valuation is messy. What about trying to estimate an intrinsic value, maybe using a discounted cash flow or DCF? Model a cornerstone of value investing. Can we even do that here?
Applying a DCF to MicroAlgo is, frankly, an exercise in speculation, not rigorous valuation. The model's output becomes entirely dependent on assumptions that are just impossible to make with any confidence, given their negative cash flows, inconsistent reporting, unproven business model.
Garbage in, garbage out, basically.
Pretty much. Even if you constructed a wildly optimistic turnaround scenario, you assume their quantum narrative somehow becomes reality, they capture a tiny slice of the huge AI market. The estimated intrinsic value would likely still fall significantly below the current trading price.
So even best case, it looks overvalued.
Yes, it suggests severe overvaluation even in a fantasy scenario. Based on their audited fundamentals, the actual intrinsic value is likely close to zero or even negative.
That's a stark assessment.
Yeah.
So to even attempt a DCF, you'd be making some pretty heroic assumptions, as you said. What kind are we talking about?
Oh, absolutely heroic. You'd need a heroic assumption about growth believing they'll suddenly reverse from negative cash flow to sustained high growth. You'd have to believe their unproven quantum narrative magically turns into commercial reality.
A leap of faith.
A massive leap. And then you need to apply a very high discount rate, easily 20–25%, maybe even higher, just to reflect all the extreme risks involved. Country risk, microcap risk, financial risk, governance risk, execution risk. It just becomes an academic exercise with no real connection to reality.
All right, let's shift gears then. Moving into part 2, market, ownership, risk, and conclusion. Let's start with chapter 4, market sentiment. What's the general market perception of MicroAlgo? Who's actually paying attention?
This is where it gets really telling. There's a complete absence of coverage from major reputable financial institutions. No big banks, no well-known analysts covering this stock.
That silence speaks volumes, doesn't it?
It really does. It's a significant red flag in itself. It suggests the company is either too small, too risky, or frankly just not credible enough to warrant serious analyst attention. The only available analyst ratings you find come from automated AI-powered services. And tellingly, they are overwhelmingly bearish, assigning sell ratings across the board.
Okay, so no real analyst, just algorithms saying sell. What about news and the general media tone? Is there much independent reporting, or is it mostly the company's own narrative?
Very little independent reporting. MicroAlgo's media narrative is almost entirely shaped by its own prolific promotional press releases, which then get republished by newswires.
So echo chamber effect.
Exactly. There's very little independent critical journalism. What you do see is a clear pattern. The stock price surges in direct response to these announcements, like that July 2025 quantum algorithm news caused a sharp rise. This is a classic hallmark of a speculative instrument, where price is driven purely by hype, not fundamentals. In fact, some sources explicitly note the pump and dump characteristics associated with the stock's trading pattern.
Price driven by PR, not P&L. Got it.
Yeah.
What about market indicators like short interest? That can be a powerful signal of market sentiment, right?
This is perhaps the most powerful indicator of market sentiment for MicroAlgo right now. Their short interest is exceptionally high. Fintel reported a staggering 59.43% of the float sold short as of the analysis date.
Wow, nearly 60%. That's huge.
Massive. And it saw explosive growth from around 500,000 shares shorted in January 2025 to over 13 million by the end of June 2025. This represents a massive directional bet by the market that the stock is severely overvalued and is heading down.
So the smart money, or at least a lot of it, is betting against it.
Overwhelmingly so. Now, high short interest can sometimes lead to violent short squeezes if there's unexpected positive news, but the underlying message from sophisticated market participants is incredibly bearish.
And from a technical analysis perspective, moving averages, charts, does the technical picture align with this bearish fundamental one?
Well, after a recent spike, the stock was trading above its short-term moving averages, but you have to view those in the context of a much more negative long-term trend.
Okay.
From a longer-term technical view, the outlook is quite bearish. On June 18th, 2025, the 50-day moving average crossed below the 200-day moving average. That pattern is known as a death cross.
Not a good sign.
Not at all. It's a significant technical signal, often indicating a long-term downward trend is in place or beginning, and it aligns perfectly with the fundamentally bearish case we've been building here.
Okay, let's move on to Chapter 5, ownership structure. Who actually owns significant chunks of this company? Institutions, insiders, and what does that tell us?
Well, institutional ownership is extremely low. We're talking between maybe 2.3% and 7.1%, depending on the source, with a minuscule number of firms involved, like only 19.
So not many big funds interested.
Exactly. What's more telling is the lack of premier blue-chip long-term value funds on that list. The largest holders are mostly a mix of smaller asset managers and, interestingly, high-frequency trading firms.
HFTs, what does that suggest?
It suggests involvement in short-term trading, arbitrage, or market-making activities, rather than any kind of long-term belief in the company's value. They're likely playing the volatility, not investing in the fundamentals.
What about insider holdings? Are the people running the company, putting their own money where their mouth is, buying shares?
Well, as a foreign private issuer, MicroAlgo is exempt from some of the stringent U.S. insider transaction filing rules. So available data shows 0 reported open market purchases or sales by insiders.
Israel.
However, remember the parent company, WeMe Hologram Cloud Inc., they are the ultimate insider here, and they've engaged in these more sophisticated forms of insider action through those highly beneficial financing transactions we discussed.
Like the convertible note.
Exactly, like that June 2025 convertible note. It was structured specifically to benefit WeMe at the direct expense of public shareholders. That represents a clear, significant transfer of value away from minority holders to the controlling insider.
So ownership is highly concentrated with the parent company, WeMe. What are the implications of that for you if you're a minority shareholder just holding common stock?
It means your influence is essentially 0. Ownership is highly concentrated, WeMe is the controlling shareholder, and they explicitly intend to maintain over 51% control.
So they call all the shots.
Completely. WeMe dictates strategy, financing, votes. It effectively renders minority shareholders powerless to influence corporate governance or prevent further dilutive actions. You essentially have no say and very little protection against decisions that might primarily benefit the parent.
That sounds incredibly risky for outside investors.
Yeah.
Which brings us neatly to Chapter 6, risk assessment. Let's maybe break this down using a quick SWOT analysis. First, what are MicroAlgo's limited strengths, if we had to list some?
Okay, strengths. Well, they have temporary liquidity, but that's thanks to the aggressive dilutive financing.
Right, borrowed time, borrowed money.
Exactly. There's exposure to that high-growth Chinese AI data processing sector, in theory. And they have that stated R&D focus on quantum computing, which, as we know, fuels their narrative, even if it's unproven.
Okay, and the weaknesses?
Yeah.
Where are they most vulnerable internally?
Oh, the list is long here. The massive credibility gap between audited losses and unaudited profit claims is probably number 1. Then, the unsustainable business model, negative operating cash flow, constant reliance on external capital, poor corporate governance, those related party deals benefiting the parent, and just a fundamental lack of any competitive moat.
Are there any genuine opportunities out there for them? What could potentially go right, even if it's a long shot?
Well, purely speculative possibilities exist. There's always the chance, however remote, of technology commercialization if their intellectual property somehow proves legitimate. Maybe they could license it.
Maybe.
Or perhaps potential as an acquisition target if the IP proves genuine, though, frankly, their governance issues would be a major deterrent for any serious buyer.
Yeah.
And then there's the broader strategic support from the Chinese government for the tech sector, but that's very macro, doesn't guarantee success for MicroAlgo specifically.
Okay. And the threats. It sounds like there's some really significant external challenges.
Yes, the threats are severe. The financing death spiral is probably the most acute and immediate threat. Remember how those convertible notes work? With deep floating conversion discounts.
Yeah, the ones that benefit the parent.
Right. It creates this vicious cycle. The stock price falls, so more shares get issued when the note converts, which puts even more downward pressure on the stock, leading to even greater dilution in the next round. It just systematically erodes and ultimately destroys all shareholder value.
A self-feeding destructive loop.
Exactly. Beyond that, intense competition from giants they simply can't match. The risk of regulatory scrutiny from both U.S., SEC, and Chinese authorities because of their unusual financing, volatile stock, contradictory reporting. And finally, that constant NASDAQ delisting risk, forcing those value-destroying reverse stock splits that fix the symptom, not the underlying disease.
And how do bigger picture things like macroeconomic factors or geopolitics impact a company like MicroAlgo?
Higher interest rates are tough. They make capital raising much harder and more expensive for cash-burning companies like MicroAlgo. That could accelerate their need for even more dilutive financing, potentially on even worse terms.
Right, makes the death spiral spin faster.
Could do, yeah. And geopolitically, as a Chinese company listed on a U.S. exchange, it's incredibly vulnerable to escalating U.S.-China tensions. Things like investment bans, forced delisting legislation, any of that would be absolutely catastrophic for the company and its shareholders.
That's a lot to weigh. Let's try to bring it all together now in Chapter 7. Conclusion. If we were forced to summarize the bull case for MicroAlgo, what would it even be?
Honestly, the bull case for MicroAlgo is entirely speculative and purely narrative-driven. It requires you to believe that their quantum and AI press releases represent genuine breakthrough technologies.
A big leap.
Huge. You have to believe that the unaudited 2024 profit claim signifies a true sustainable turnaround despite the audited history. And you have to believe that this management team can actually commercialize this tech in a hyper-competitive market. For bulls, the stock's extreme volatility is just seen as a high-risk, high-reward trading opportunity for short-term gains.
Okay, that's the narrative case. What about the bear case? It sounds like the evidence is much stronger there.
The bear case is, frankly, overwhelming and supported by a wealth of evidence. You've got the systematic shareholder dilution through that death spiral financing, severe corporate governance failures, the parent company control, the self-serving related party deals, that profound credibility gap between audited losses and questionable unaudited profit claims.
The fundamentals just aren't there.
Exactly. Fundamentally, it's an unprofitable business with negative operating cash flow, totally reliant on external capital. Its whole narrative seems divorced from reality, exhibiting classic pump-and-dump characteristics. And then you have that overwhelmingly bearish professional sentiment, lack of reputable institutional ownership, and, critically, that exceptionally high short interest, over 59% of the float. The market is screaming caution.
So any attempt at intrinsic valuation using models like DCF is largely futile then, just an academic exercise.
Absolutely. Any attempt to assign an intrinsic value using a DCF model here is futile. The inputs are just impossible to predict with any reliability. Even under the most optimistic, almost fictional scenarios, the model suggests the company is significantly overvalued at current prices. Based on the audited fundamentals, the true intrinsic value is likely negligible, maybe even negative.
So what does this all mean for MicroAlgo's outlook as of today, July 15, 2025? What's the final takeaway?
As of July 15, 2025, MicroAlgo Inc.'s share price, floating around 61 cents, seems completely untethered from any discernible fundamental value. Its price appears to be largely a function of a speculative bubble fueled by retail trader interest and ignited by those promotional news releases.
So the swings could continue.
Oh, violent price swings may certainly continue. That's nature of these kinds of stocks, but at the end of the day, the company fails to meet any of the core tenets of a sound long-term investment. The risks, the dilution, the governance failures, the credibility issues are simply profound and, based on this analysis, insurmountable for a prudent investor.
Wow. As we've seen with MicroAlgo, sometimes a company's story can be incredibly different from its financial reality, especially when the source material itself, like today's AI report, gives you such a clear picture. So after this deep dive, what really stands out to you, our listener, about distinguishing genuine innovation from just pure narrative? How do you make sure you're equipped to critically assess information no matter how slickly it's presented? Something to think about.
Definitely. And if you found this deep dive valuable, we really encourage you to like and subscribe to the Stock Analytics AI YouTube channel. Remember, Stock Analytics AI members get priority deep dives on tickers. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
That's right. And if you want a one-off deep dive on a specific stock that's caught your eye, just drop us a super thanks on the video. Finally, just a crucial note. This deep dive was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.